There are a few reasons why you should be really worried about the economy. However, you should also buy stocks. It sounds strange, doesn't it? Let's talk about it all. Hello everyone and welcome to my YouTube channel. Thank you very much for following me. Thank you for subscribing, it's very important. Leave a comment below and give a like to this video if you like it. It's very important as well. Everybody is analyzing the economy and the macroeconomic environment with a very logical perspective. Debt continues to soar, particularly in developed economies. There are very strong headwinds in most of the developed economies. We can see that the manufacturing indices are showing contraction, certainly in the manufacturing sector, and also now quite an evident weakness in the services sector. The main narrative is that the Fed is going to achieve a soft landing. However, we must understand as well that what the Fed calls a soft landing is what they always call a soft landing. We saw in 2007 how most of the mainstream international bodies assumed that there would be a soft landing. The IMF, the Fed, etc. And in 2008, a crisis. The longer it takes to get to a normal and perfectly acceptable recession coming from the excesses in both the monetary side and the fiscal side that we have seen in the past years, the worse the contraction will be. Right now, what we are seeing in the US economy is fundamentally a GDP that is bloated by monster government spending. It is atrocious to see that the US government is going to have its record deficit in a year in which there is absolutely no problem in the economy, and with a massive increase in indebtedness that is just soaring well above any other estimate in an environment of growth, higher tax receipts, in what should be the perfect environment to reduce debt. The US government is massively increasing its imbalances. So we are in a private sector recession. There is a private sector recession. The services, manufacturing sector, consumer confidence, the reality of real wages. Don't talk to me about nominal wages. The reality of corporate margins. In most of those areas, we see a very evident trend of weakness. However, everybody's talking about a soft landing because we don't see a GDP-driven recession. And GDP, obviously, is helped by higher government spending, higher debt, and lower imports. A very important factor. Now, we see that energy, commodities, food commodities, most of the commodity complex is going back up and it's reaching pre-Ukraine war levels. That means that the tailwind that the economy had in terms of lower commodity prices is behind us. The tailwind also of low interest rates and hugely accommodative monetary policy is also behind us. And now what we have to see is what will be the impact of the rate hikes. Right now, we have only seen the beginning, the tip of the iceberg of the effect of rate hikes. Why? Because it takes between 18 to 24 months after the last rate hike to really see what is the impact on the economy. So, the trend in job creation is slowing down. Services, manufacturing are either close to contraction or in deep contraction. There are numerous elements that show that we are in a private sector recession. But the market is very happy. Why should you buy stocks in this environment? It's a monetary factor. Ultimately, the Fed is reacting slowly and in the wrong way to inflation. It is increasing rates, which hurts the private sector, particularly families and small and medium enterprises, and maintaining a very high level of liquidity. The balance sheet of the Federal Reserve remains at 37% of GDP. Furthermore, every time that there is a problem, as we saw with the Silicon Valley Bank and the regional banks, it injects liquidity massively and the balance sheet goes back up. So there is no surprise when we talk about a level of global money supply growth that is remaining very stable with a very small contraction compared to the massive increase of 2020-2022. So, yes, there is monetary contraction, but it's very far away from coming back to the levels of pre-2020 environment. Certainly, private sector credit growth remains relatively stable, and it's very important to see that delinquencies and bankruptcies are not that aggressive. But that always happens before a recession. Delinquencies, bankruptcies are always a post-fact element. We saw it in 2007 as well. One of the main reasons to say that there was going to be a soft landing was precisely the fact that bankruptcies in 2007 and credit card delinquencies remained relatively subdued, nothing to write home about. Okay, furthermore, why would we have to buy stocks in this environment? Because there is no other alternative for central banks and for governments than to accelerate monetary repression if there is the slightest contraction in the economy. The problem of an economy that is so bloated, that is so dependent on stimuli, is precisely that it needs more and aggressively larger stimulus packages in order to just maintain its position. Therefore, what we see as a threat to stocks, which is that multiple expansion has driven the economy, that the economy is weakening, that debt is artificially bloating GDP, and all these factors, which are absolutely correct, is missing only one factor, is that we believe that central banks are going to follow their mandate of price stability and of employment, in the case of the Federal Reserve. They're certainly not following the mandate of price stability, and they will not follow it if there is a contraction in the economy. Therefore, the risk of stagflation is much larger than the risk of a recession that drives stocks lower with monetary compression and reduction in the monetary aggregates going further. Yes, unfortunately, we live in a monetary debasement environment. Everybody's talking about a strong dollar, but the dollar is not stronger. The dollar is losing purchasing power. The problem is that all other major currencies are losing more purchasing power relative to the US dollar. As we have seen, for example, if we analyze the behavior of the US dollar and the rest of the major currencies relative to gold, gold is up, the dollar and the rest of them are debasing all of the time. So, central banks will continue to disguise fiscal problems and global macroeconomic issues with monetary policy. It's not that they're evil. It's not that they don't want to try to defend the purchasing power of the currency to a certain extent and price stability. It's that there is no other option, because this is the first recovery in history in which, with an inflationary burst like the one that we have lived, governments are not just not reducing spending, they're increasing spending. Governments are acting as if there was no inflation, and they are creating more inflation. So the private sector is contracting, or at least worsening. The public sector is bloating. The size of government in the economy is rising, and the level of adherence of the monetary policy to the fiscal policy is broken. So monetary policy is going one way, fiscal policy is going the other. Fiscal policy is monstrously expansionary, wrongly called expansionary, by the way. We could call it debt creationary, if that word exists. We just created it. But it is extremely important to understand that monetary debasement is going to be the only solution ahead. There is no other option. Governments are not going to cut spending. In fact, they will probably increase it if there is a contraction. They will present themselves as the solution to the problem that they have created. Furthermore, it is almost impossible for central banks to be prudent in their monetary policy when fiscal policy is becoming irresponsible. And central banks can do as much as they can, which is simply to improve a little bit their balance sheet and improve a little bit the level of rates relative to inflation, but they cannot do anything else. So that's what creates the risk of stagflation. And in that environment, my friends, multiple expansion of stocks is very likely to continue because there's nowhere else to hide. Of course, you can invest in gold, and you should invest in gold, and you should have a long exposure to the US dollar relative to the rest of the currencies, because it's not a game of who wins, but a game of who loses first. And obviously there, the dollar is the building with the highest number of windows and doors in the middle of a fire. So we need to have some cushions in the portfolio, dollar and gold, and we certainly need to have stocks. And we need to have stocks that are benefited by monetary expansion in periods of contraction. Those are not the value stocks. Those are precisely those that are more expensive, those technology names that benefit from monetary expansion and at the same time continue to enjoy very significant margins and very significant levels of cash generation and growth. So we need to protect ourselves against monetary debasement. And what that tells us is that, unlike what you hear a few times, bonds are not that attractive. You have to be very selective with bonds. Particularly, sovereign bonds are not going to be attractive because that combination of fiscal and monetary policy is always going to go against the savers in both deposits and those investors in bonds, in sovereign bonds. Ultimately, currency debasement has one objective, which is to disguise the imbalances of the government. So the government is not going to pay you more for your hard-earned money in your investments. It's going to pay you less, and it's going to reduce the value of your investment via the currency and via the yield, both. So, challenging times. Multiple expansion coming after enormous stimulus packages that have to be built upon those stimulus packages because the economy simply does not generate a multiplier effect from these enormous spending plans and these enormous monetary injections. But we need to think about our savings and our investments. And we need to think that the entire bet coming from international bodies, governments, and central banks is that savings will be eroded against the imbalances of the public sector. So the only way to partially or at least fully get some level of return on your money is precisely to take exposure on long duration stocks, i.e. technology with high level of margins and high level of resiliency in terms of their ability to keep their margins, continue to have a significant proportion of gold, silver, precious metals, and the dollar relative to most developed economies' currencies. Think about it. When Japan allows its yen to go to 40-year lows, the euro goes after it. Keep defending freedom. Thank you for watching this video. Please subscribe to my channel, like my videos, leave your comments below, and keep defending freedom. Thank you very much.